What we're looking at right now is the trajectory of the Vanguard Real Estate Index Fund ETF. And of course, given our high interest rate environment over the last year, we see that this ETF is still in the red, down by over 3% from this time last year. Now, you're likely not here for some pitch on a real estate ETF opportunity, but I'm going to assume that you just might be interested in earning monthly dividend income. And if that's the case, then we're going to go ahead and get to some insights on that particular Vanguard Real Estate ETF, and then cover 3 monthly paying dividend stocks that you should have your eyes on right now. Ready? So just before we get going with these 3 monthly paying dividend stocks, I want to go ahead and have you take note of the fact that over the last year, the Federal Reserve, along with the world's central banks, have unleashed the steepest series of interest rate increases in decades to really tame in inflation. Now, their mission is not necessarily accomplished, as inflation remains above the Fed's goal here of 2%, but it does appear that the rates won't be hiked moving forward. As a matter of fact, both the sentiment and rumors on the street are that we're going to get some serious rate cuts this year, which would result really in the commencement of a bull market. But not all sectors are created equally, and certainly some would gain more momentum than others. Real estate being one of those sectors that would gain more momentum, hence why I highlighted the Vanguard Real Estate Index, which I want to pull up once more on screen for you to take a look at. You see, interest rates continue to go up, this index then continued to slide down, and that volatility lasted until around October, where we eventually regained some hope and optimism that rates would be cut. Yet the question is, what does this have to do with anything, especially these monthly paying dividend stocks? And the answer? Everything. You see, when interest rates are higher, many companies, especially REITs, have trouble getting loans, and then many are actually just troubled with defaulting on those loans. But when rates actually go down, companies are gifted with the firepower to actually spend. Real estate being a specific sector where the industry at large is just all about leveraging debts and then therefore booms. And the best news for all of us right now, as long as we're invested into companies with strong leadership teams and clean balance sheets, we can collect on monthly income in the form of dividends. So first up, I just want to go ahead and throw this one your way and get it out of the way. Realty Income, ticker symbol O. It's everyone's favorite monthly paying dividend company, and no, that's not just because of their slogan, but because the Realty Income team actually created and then scaled the largest net lease solutions portfolio, consisting of over 13,000 properties with a footprint in all 50 states, while also operating internationally as well, with a growing presence in the United Kingdom and throughout Spain as we speak. Now, through the thick and thin, Realty Income has maintained a very strong occupancy rating, coming in at either 98% or 99%, meaning their properties remain leased through all the ups and the downs. And at the end of the day here, we're going to go ahead and collect on rent through dividends. However, it's all about buying at the right price. So right now, Realty Income has tumbled back below $60 per share, trading right now for $56 per share. That's down by over 10% from this time last year, down already by almost 2% year to date. But zooming out here, we're going to see 130% worth of appreciation as the company has scaled that portfolio. Now, in addition, analysts also remain very optimistic, forecasting over 10.31% worth of upside, coming up to a share price of $62.35 per share, along with promising signals from hedge funds, as they scored more than 248,000 shares of Realty Income last quarter. But let's now dive into these dividend insights here on Simply Safe Dividends. We're going to find a reliable dividend yield coming in at 5.45%, which has been paid out over the last 54 years and growing by roughly 5% on average over the last 20 years. Now, investors, before I actually get to these next 2 dividend stocks, I want to go ahead and have you take massive action this year, ensuring that you never miss a single video. That's all you have to do is join me here on the channel by subscribing. And if this is in fact the content that you're looking for on a weekly basis, you're getting value from this content, tap on that thumbs up button while you're at it. Just lets me know to keep creating content just like this. With that, let's get back to it here with Phillips Edison, that's ticker symbol PECO, which in terms of safety for a monthly paying dividend stock as of this video comes in second, just after Realty Income on Simply Safe Dividends. But I want you to know that Phillips Edison deals directly in grocery anchored shopping centers and primarily leases spaces out to medical, restaurant, salons, and retail tenants. But all in all, the company's portfolio primarily consists of neighborhood centers anchored by the #1 or #2 grocery tenants by sales totaling up to 291 shopping centers across the US, in which 271 of them are actually wholly owned by Phillips Edison, as opposed to, say, Realty Income's big box department stores or convenience stores like your 7-Elevens or CVS's. That all just means that in certain environments, economically speaking, it can falter. But surprisingly here, it's actually done quite well over the last year. It's up by over 12%, trading for $35 per share. So then hold on here, why is this one even on the list? Well, in a more friendly rate environment, we may get some more upside here, which is exactly what analysts are foreseeing, over 5% worth of upside coming up to $37.50 per share, while hedge funds have actually been scoring more shares last quarter, over 12,000 shares worth. But here's where I want you to focus when it comes to this specific REIT. We have a dividend yield that's coming in at 3.28%. I'm going to warn you here that we have a negative growth rate over the last 20 years, which makes sense given the company's operations. But again, this is just one to have on your watch list. So how about we get back to it here with another REIT that has actually been really proving itself well over the last decade to 2 decades. We have Agree Realty, ticker symbol ADC, focused on similar clients to Realty Income, from Walmart to Home Depot, TJ Maxx, Aldi, Tractor Supplies, CVS, and the alike. All in, Agree has amassed a portfolio of 2,084 properties across 49 states, founded back in 1971, that all allowed for explosive growth since that time. We're talking about 232% worth of appreciation over the last decade. Yet this past year, in that economic environment, nearly 14% worth of a decline. Analysts, however, foresee upside coming up to $68.17 per share. Insiders, from the chairman of the board to the CEO himself, have been buying more shares of this REIT. And not only that, but we have hedge funds that have been loading up here 40,000 shares of this REIT purchased last quarter. And with Agree, we can all agree that it's a nice monthly paying dividend company, coming in with a yield at 4.85%. That has been ongoing here on their streak of 11 years, with a 2% growth rate over the last 20 years. Not much growth, but nonetheless, there is growth there in terms of a monthly pair. Now, investors, let me know which of these stocks you own, which ones you're favoring, which ones you're running in the opposite direction from, or if you have better ideas in mind. Drop all those comments down below. Find more insights right here, and of course, subscribe to never miss a single dividend stock idea.